Okay, welcome back to the lecture 2 of chapter 1. Okay, so we left at the difference between IFRS in terms of the organization structure difference versus GAAP. And now we'll continue to talk about IFRS. So first of all, since 2001, the IASB has revised many international standards and has issued a new standards on its own, and it's giving a name officially called International Financial Reporting Standards, and short for IFRS. And then more and more people and countries start basing their own national accounting standards using IFRS as a structure or directly use IFRS. By 2018, there's more than 100 jurisdictions, including Hong Kong, Egypt, Canada, Australia, and the countries in the Europe Union require or permit to use IFRS or a local variant of IFRS. And then, so the most important thing is as a financial user, financial standard preparer in US, and versus the whole world, about 120 jurisdictions are using different language, which is IFRS. What's going on here, and are we gonna converge together? If so, is anything has been done? Yes. So this is a valid question. FASB and the IASB has been working for many years trying to converge on one set of accounting standards, because US is the most developed capital markets in the world, and a lot of most important public firms and the biggest firms are in US, and so does FRS user European Union. So this is the biggest capital market out there, speaking different language. So it's very critical for everyone to have a comparability and understandability between each other. And this effort has never been, easy. Therefore, it can explain why now hasn't converged yet, right? However, recent events suggest the full convergence will not be achieved in foreseeable future. And while it appears likely that the FASB and IASB will continue to working together to converge where it's possible, but some differences between IFRS and US GAAP will remain forever. Okay. And then now, as you can see, there's a taste of politics actually involved in the financial accounting. It's not as simple as just of accounting standards. Okay. And then we can actually go into details about what kind of politics there are. And for example, in our example here, in US GAAP, there's two politics involved the standard setting that I want to mention. One is stock option, another one is a fair value accounting. So a changing in accounting standard can result in substantial redistribution of the wealth, right, within the economy. Therefore, it's no surprise that the FASB had to deal with a lot of intense political pressure over controversial accounting standards, and sometimes has changing standards in response to the pressure. And let's use the mid-1990s, the stock option as example. And what is this stock option actually stand? It's related to employee stock option. Okay, so nowadays the CEO or executive or even normal rank and file employee in the company usually or given stock options, right? And which is a contract that's saying that there's a certain criteria that you need to perform to be achieving, and then the option can transfer into buying your own firm's share at a certain price if you work well, and then the stock price usually will be higher than the stock options purchase price, hence that you can cash out your compensation. So therefore, the stock option itself has a market value as well. So the accounting standards in place at that time, which is in 1990s, typically did not recognize employees' stock option or compensation as an expense. Okay, in 1990s, if you give someone option, since it does not impact, it's just a contract in form, and then it takes years for the option to be effective, so therefore they didn't treat it as an expense yet. But in the essence, company was sacrificing something of value to compensate the employee, because this option is actually can transfer into cash value based on the option period, right? Therefore, FASB proposed that companies recognizing compensation expenses in account equal to the fair value of the option. So, in other words, the FASB will say, hey, this is not right. You cannot just not recognize these expenses, right? Those people work for you, hence that you compensate them equally, and instead of cash you give them stock option. But why don't you recognize that as expense? You should be. And then if you do, when you recognize the expense, you should find out the fair value of the option and recognize that as expense. Okay, with the sum expenses recognized in each period in which employee earned the option, right? And numerous companies, particularly the California Silicon Valley, where the high-tech company have been compensating employee majorly by using stock option, to a great extent, apply intensive political pressure, say, hey, no, we are not going to recognize the stock option as expense by using the fair value of the options. And to extent that eventually the FASB backed down and require only disclosure. Okay, so the FASB was saying that, okay, you know what, I cannot fight you guys. Okay, at least please disclose it. Okay, disclose option related compensation expense in the notes section of the financial statements. And nearly a decade later, okay, this continuous issue resurfaced, and in an amendable political climate, and FASB issue a standard requiring, so right now require trying to expense the stock option. Nearly in 2000, right, in a decade later. Okay, so this is first example. The second example is the implementation of fair value accounting issued in 2007. So this is another story, is interesting, saying, for example, specifically, many financial assets and liability are reported at the fair value, okay, in the balance sheet, and many type of fair value changes are included in the net income. Some have argued that the fair value accounting were estimated in a manner that exacerbates the financial crisis in 2008 to 2009. Okay, by forcing the financial institution to take a larger than necessary write-down, because a lot of the asset or liabilities is actually inflated by the fair value of accounting method, and then those assets in illiquid market that existed at that time has been write down so much, caused the financial institution in 2008 and 2009 have a lot of losses. And then we will discuss this in chapter 12 of this book. The pressure from lobbyists and politicians influenced the FASB again to revise their guidance on recognizing investment losses in this situation. And such ongoing pressure remains to reduce the extent to which fair value changes are included in determinants of the net income. So in other words, nowadays the net income, although should have a lot of fair value evaluation between the liability and the assets, including the net income section, but because of political pressure, such fair value accounting can only be executed in a limited fashion. Okay. And then let's look at the international financial standards. Do they experience politics as well? And then apparently the political pressure on the IFSB standing process are severe as well. Politicians from countries that use IFRS lobby for the standards they prefer, right? European Union is particularly important adopter of IFRS and utilize a formal evaluation process for the determinants whether an IFRS standard will be endorsed for use of in the EU countries. The economic consequences of EU member nations are an important consideration in that process. In 2008, the EU successfully pressured IASB to suspend its due process and immediately allow reclassification of investment so that EU banks can avoid recognizing huge losses during financial crisis. Commenting on the standard setting at that time, Charlie McCreevy, European Commissioner for International Market and Service, stated that accounting now too important to be left to accountants. Okay, so let's see. Based on this, then what is the high quality financial standard if everybody can pressure the standard setters to changing their mind? Okay, so first of all, we have auditors, right, to ensure the credibility of financial statements, okay, because they can express an opinion on the compliance of the GAAP. And second of all, and these people are very professionals, they can also provide very professional opinions on the compliance status because they are licensed, they have to take exams. And I suggest everybody start to looking into how to take a CPA exams because this can boost your employment opportunity at least 50 times higher than the peer who does not have a CPA. Okay, because in order to sit in the CPA exam, you have to have 120 to 150, depending on the state's credits that is majoring in accounting. And after you sit in the CPA exam, you can be licensed by each state that you want to practice your services. And then once you have a CPA license, you can provide an auditing service to offer an opinion on the fairness of compliance with GAAP. Okay, so financial reporting reform. Okay, now we want to talk about the most important financial reporting reform since 2000s. Okay. The reason that we needed to have a financial reporting reform because there's a lot of high-profile accounting standards, accounting scandals such as Enron, WorldCom, Xerox, Merck, and Adelphia Communication, and all this public collapse of industry giant tells us that accounting scandals are so big and so accounting fraud and scandals can be so critical, so damaging to extent that bring down a big corporation, right? So therefore, there's increased pressure on the lawmaker to pass the measures that would restore the credibility and the investors' confidence in the financial reporting process. So in 2002, there is the most famous Sarbanes-Oxley Act. And the key provision of Sarbanes-Oxley is including, first of all, oversight board. So establish the PCAOB board who is overseeing all the CPAs, right? So as long as you providing your opinion about the financial statements as auditors, okay, Sarbanes-Oxley formed the oversight board of PCAOB to oversee the credibility of auditors. Second of all, corporate executives need to issue their own opinion on the internal control effectiveness of the company. And second of all, the company like Big Four company who offer the auditing services cannot offer non-auditing services anymore. Okay, so if say KPMG offer auditing services, they cannot offer non-auditing services such as tax services or consulting services towards that company. And also, every auditors who audit the public company need to retain 7 years of their paperwork. Okay, you cannot to delete the paperwork until 7th year. And then every 5 years, they need to have a rotation of auditor. So for example, Jiehao is auditing, say, Apple for 5 years, and then after my 5th year, my peer, my coworker, gonna auditing Apple. This because it avoiding collusion between the executives and the auditors, right? Because if 5 years is long enough for the executive and me to have a good relationship, to let them go in terms of certain misconducts. And then by doing the auditor rotation, someone new will take a look at Apple's financial statement using fresh pair of eye, so that can detecting some things going on. And conflict of interest means that if me audited Apple in 2019 and I quit my CPA job, my auditor job, and then I wanted to go back to the industry. I wanted to work for Apple's because Apple people loves me because I did their auditing. That is not that's not possible because there's a conflict of interest, meaning that I used to offer the opinion on Apple, and I cannot be Apple's executive within 1 year. Okay, and then also the hiring auditors responsibility. Originally, it can be anyone in the company, such as board, or president, or even CEO. Right now, these people cannot hire auditors. There has to have an audit committee, okay, to hire responsible for the hiring responsibility. And also, the auditors need to provide a section 4 opinion on the internal control weakness of the company. So this means that auditors not only have to express their opinion whether the financial statements is complying a gap, they also need to look at the internal control of the company, whether it has any kind of weakness. So all these things should be already covered in financial accounting class. If not, this will be a good time for you to review it. Okay, and another big thing about the financial standards is that it's gradually moving away from rule-based standards and then move into objective-oriented or rule-based standards. So a principle-based, move away from rule-based accounting, more gradually move to principle-based or objective-based accounting. What is a principle-based accounting? A principle-based accounting approach to the standard setting stress the professional judgment as opposed to following a list of the rule, right? For example, if you are rule-based accounting, you say if your financing choices is about 80% of the threshold is through the renting arrangement, then the asset, right, has to be expensed instead of capitalized. This we will talk in details in the future. If you give someone a rule saying that if you're under this 80% or 70%, you're doing one thing, and above this you're doing another thing, right? Action A, action B, and then this bright line will be a target that people can manipulate. For example, if I want the asset being capitalized, I will make sure I constructing a contract that is above 70% or 80%. If I wanted to expense that asset to put on the expense for some reason, then I can make sure that I construct this contract about 79%, right? So if you set a rule, people can bend the rule, right? If you set a principle, people is hard to bend the principle because people usually using a professional judgment to understand the transaction, whether it's a objective oriented or is complying with the principle or not. Regardless, a poor ethical value on part of management are at the heart of accounting abuse and scandals. Because US GAAP originally a lot of rule-based accounting. Hence, the people who are opportunistic at a management position are able to bend those rules to creating a desirable financial statements that's gonna desirable for their future, but not desirable for employee, for the public, for the investors and creditors. So therefore, gradually we want to move away from rule-based accounting to principle-based accounting. And then now, since we talk about the opportunistic of the management, then we wanted to talk about what is ethics and what is professionalism, right? So ethics deal with the ability to distinguish right from wrong, and a code of ethics or code of professional conduct are provided, especially for accountant, okay? Is provided by the AI CPA. If you passing the CPA exam, you will have in say Philadelphia or Pennsylvania, each state have its own code of conduct ethics exam that you need to pass to get the certification. And also there's Institute of Management Accountants, and there's the Institute of Internal Accountants. And then how do we judge whether a decision is an ethical decision? Okay, first of all, we wanted to determine the facts of the situations, and then we want to identify the ethical issue and the stakeholder that decision might have impact on. And then we want to identify the value related to the situation. If the action taken on one course, what could be the value associated with course A? If we change our mind to take the course of course B, what could be the value involved in that course of action? And then we wanted to specify alternative course of action, how many action is, and whether there's an alternative action, right? And then we're gonna sit down, we want to evaluate the course of action specified in step 4 in terms of their consistency with the value identified in step 3. And then once we identify the consequence of each possible course of action, and we will make our decisions as indicated. Okay, so concept check, high quality financial reporting. Which one of the following is not one of the way in which high quality accounting standards accounting is encouraged by US financial reporting system? A, accounting standard encourage comparability. Exactly. Auditor assess whether financial statements are materially misstated. Yes. Sarbanes-Oxley instituted reform designed to improve quality of financial reporting. Exactly. Managers are required to use a framework for ethical decision making while deciding how to accounting transactions. No. Okay. Ethical frameworks can be very useful, but managers are not required to use them to account for transactions. In order to account for transactions, you use GAAP. You don't use, you are not the ethical framework. Okay. Okay. Conceptual framework is the second part B of this lecture, and we want to discuss the foundation of the financial accounting. So first of all, in order to building something sturdy, right, the US Constitution is the foundation of the law and the land. The conceptual framework here is gonna be the foundation for US accounting standards. That's why we call it the accounting constitution. And then it's providing an underlying foundation for US accounting standards. and it guides the selection of events to be accounted for and the measurement of those events and the means of summarizing and communicating them to the interested party. It provides a structure and direction to the financial accounting and reporting. And it is disseminated by FASB through the Statement of Financial Accounting Concepts. Okay, so first of all, we wanted to see this foundation, okay, this conceptual framework. It has objective, and then also objective including the objective will constructing the elements, and elements constructing financial statements. And then from the elements to financial statements, there also has to have a qualitative characteristics that need to meet the usefulness standards, and also have a cost and usefulness constraints to make sure that the information is valuable enough but not too costly to include in financial statements. And in the meantime, there also have a certain recognition and measurement concept we need to consider in order to flow from elements to financial statements. Okay, in other words, financial statements and their elements are the most informative when they process specific qualitative characteristics. The proper recognition and measurement of financial information relying on the several important assumptions and principles that underlie financial reporting process. Okay. So first of all, international financial standards, role of conceptual framework versus GAAP, right? The role of a conceptual framework. The conceptual framework in US GAAP and IFRS are very similar, and they are converging even more without the ongoing efforts by FASB and IASB. However, in US GAAP, the conceptual framework primarily provides guidance to standard setters to help them to develop high-quality standards. In IFRS, the conceptual framework guides the standard setting, but in addition, it provides a basis for practitioners to make accounting judgments when another financial accounting standard does not apply. Also, IFRS emphasizes the overarching concept of financial statements provide a fair presentation of the company. And US GAAP does not include a similar requirement, but US auditing standard requires such consideration. Okay. So first, objective, and we're first going to talk about what are the objective of financial reporting. And then we're going to talk about the qualitative characteristics of financial reporting information. So the hierarchy of qualitative characteristics of financial information. First of all, the objective here, I wanted to re-emphasize, is to provide financial information that is useful to capital providers in making decisions. Remember the investment option A and B. Right now we're talking about how can we providing information that are useful to investors to assess risk of return and the return rate, right? So therefore, the objective of financial reporting is to provide the financial information that is useful to capital provider in the making decision. Okay, and then what kind of information here? What kind of quality of those information and what kind of constraints of those information that we need to consider in order to come up with the elements that we use in the financial reports. Okay, so there is a hierarchy of the qualitative characteristics of financial information. Step one, first of all, it has to be decision useful, right? The information that we provide is not useful, the decision is not worthy of is not what we are aim for. And to be useful, you got to have information that is relevant and also faithfully represents. And what do you mean relevant? Relevant stands for three characteristics. It has to have a predictive value and have to confirmation value and has to be material. And faithful presentation has a three characteristics. Faithful means that the information you provide has to be complete and it need to be neutral, not biased, and also has to be free from error. And then, this is the fundamental required characteristic. There's also additional characteristic or enhancing characteristic, such as the information has to be consistent or comparable, has to be verifiable, has to be timely, has to be understandable. And beyond all this, the constraints, well, what we have to consider is the cost effectiveness. You can, maybe you have information meet all this beautifulness of the quality, but it's too expensive. That means we cannot afford to report that information. Okay. So, concept check. Which of following is not a component of relevance? Okay. We said free of error is the faithfulness, right? It's on the right hand side. Materiality, it means that is this information big enough to be reported, right? So for a $1 billion company, if you say $1 of transaction, is that material enough? Probably not. Predictive value. Predictive value means that the information that you provided in the current period has a predictive value, and it means it can help the user to predict a company's future cash flow. My writing is not well, but you know what? It doesn't matter. All these things you already learned in the Learn Smart, or you can watch this just noting yourself. Okay. Predict value means that it helps the user to predict the company's future cash flow. If the information has such function, then that has a predictive value. Confirmation value. What is confirmation value? It means that if the information you provide helps investor confirm or change their prior assessment regarding the cash flow of the company. In other words, the information you provide is valuable enough either to confirm the other people's expectation or changing their expectation because of prior assessment. Okay, so these three things means relevance. Okay, and the free of error is the faithfulness of the major one. If you look at this, relevance has these three, right? And faithfulness have a free of error, right? This is that's why I choose A. It's not, right? Here is not. Okay, so sorry. And what is not? Which following is not a faithfulness or representation as the FASB conceptual framework? Free from error, yes. Neutrality, yes. Understandability, no. This is enhancing characteristics, right? Okay. Okay, so now let's look at the elements of this framework, conceptual framework. What kind of elements we use? Okay, elements stands for the components that you are used to constructing the financial statements, right? And then the components here are we call it the elements, right? They including assets, which is future economic benefits obtained or controlled by the company. Liability is a future sacrifice of economic benefits arising from present obligation of a particular entity to transfer the assets or to provide service to other entities, right? And equity stands for shareholders' equity or stock equity for a corporation. It's a residual interest in the assets of an entity that remains after deducting all the liabilities. Investment by owner, and this increases the equity of a particular business enterprise resulting from the transfer to it or from other entity of something of value to obtain the increase of earnership. Distribution to the owners such as dividends and stuff, and then it's a decrease in equity of a particular company. Comprehensive income is a changing in equity of a business enterprise during the period from transaction and other events and circumstances from non-owner resources from non-owner resources is including all changes in equity during period except those resulting from investment by owners and distribution by owners. And the revenue stands for inflow of other enhancement of assets of entity, right? Revenue or settlement of its liability during a period from delivering or producing goods, rendering services, and other activity. Expense stands for outflow of other using up of assets and incur liability during the period from delivering or producing goods, rendering services, or other activity that constitute entity's ongoing major central operation. Gains means increasing the equity from peripheral or incidental transactions of an entity, and losses represents the decrease in equity arising from the incidental transaction of an entity. In financial accounting, I'm sure that we already talked about assets, liability, so some sort of equity, and investment by owners sometimes, and distribution a very little bit, and comprehensive income. No, we didn't not cover any financial accounting. And revenues, yes, right, but not in detail. And expense, yes, not in detail. Gains and losses, just partially touched on. So as you can see, we touched on some of this in financial accounting, but there's a lot of depth within each element that needs to explore, right? Okay. So, and the underlying assumption that we mentioned in the graph, remember this graph? We said the recognition and measurement concepts, how to recognize transaction and how to measure the transactions has something to do with the underlying assumptions of each transaction. So now we will talk about the detail about this underlying assumption. There's a 4 basic assumption underlying a GAAP. First of all, economic entity. Economic entity assumption presumes that economic events can be identified specifically with an economic identity. Means ABC firms can always identify all the transactions happen to him or he give to other people related to himself, rather than say EFG transaction, EFG entity. So it means that in terms of the transaction going on, we can always identify which transaction associated with which company. Okay. And second, the going concern assumption anticipates that a business entity will continue to operate indefinitely. This is very important. So when you producing information, you always assume that this company actually is gonna be surviving. Okay. This company will continue to operate. For example, when you debit accounts receivable and credit revenue, right? You had a good faith that this company gonna come back to give you the money, and then as to render their, you already providing the products, right? And they owe you money. At that moment, you always assume that company can exist in future. Otherwise, you would not do such thing. Hence, that going concern is an assumption that anticipates the company that you deal with or the company that you're providing information will continue to operate. Okay, and periodicity periodicity assumption allows the life of a company to be divided into artificial time period to provide timely information. For example, physical year, right? Physical year, if it ends in February 1st, it does not mean that there is a stop point on the time-wise that company stopped working in February 1st. It's just artificial time segregation, separate divider that from last year February 1st to this year February 1st from last year January 31st to this year February 1st is a year of operation that we want to report a financial report on, right? So this is the artificial time period that we use. And the monetary unit. What is a monetary unit? Monetary unit means that you have to report the number in terms of money value. In US, we use the US dollar. Okay, these are the underlying assumptions. And then we talk about beyond these assumptions, we wanted to understand another important right-hand side of recognition and measurement concept, right? Recognition stands for the process of admitting information into financial statements, right? When do I recognize this expense? When do I recognize this as a revenue? And measurement stands for the process associating a numeric amount with the elements. So how much should I recognize it? How much should I recognize this expense? How much should I recognize this revenue? Disclosure stands for a process including additional pertinent information in the financial statements and company notes. So how do I disclose this item if I do not include it in the journal entry? Do I need to disclose it? How do I communicate this information in terms of financial reporting? And the general recognition criteria is the definition, measurability, relevance, and reliability. Okay. Revenue recognition is going to be our chapter 6. Okay. We're going to study in depth in chapter 6, and I'm going to use 2 weeks to study this revenue recognition because it's a new standard. Okay. So revenue, what is simply put is it's just an inflow of asset or settlement of liability resulting providing product or services to a customer. And revenue recognition used to be guided by the realization principle, right? 2 criteria. Earning process is judged to be completed or virtually completed, then you recognize the revenue. Means that you think this revenue process has been completed, then you can recognize it as money earned. And the reasonable certainty to be able to collect the assets to be received, such as cash. Not only you wanted to know that this revenue process has been completed, you also knows that you are able to collecting money out of this transaction. However, FASB issued ASU number 2014-909, which requires that recognition revenue when goods and services are transferred to the customer for the amount of company expected to be entitled to receive in exchange for those goods and services. So the old criteria, right, is just saying that you have to make sure that it's completed, then you can recognize. But the new criteria is saying that when your products and services are already transferred to the customer, whether it's complete or not, that's not the judgment anymore. As long as you transferred it to the customer, and also the amount of the company expected to be entitled to, as long as you think that portion of what you transferred you are already entitled to collect, then you can recognize the revenue. This is really helpful when it's come to software companies, right? Because software company, it has a phases of delivery services. For example, your streaming services, or you are playing video game, you buying the weapons, or you're upgrading your level. All those things is actually very abstract in terms of if you use criteria, are you completed or not, right? But when you look at you are using a new standard, you are more able to recognize when to including those transaction as a revenue or not. And expense recognition has often matches revenues with expenses that arise from same transaction. So in other words, once you are able to recognize revenue, the expense recognition is much easier because the expenses are the resources sacrificed to generating that revenue. Once you recognize what has been generated, then you can understand the resources sacrifices to supporting that generation. And then often there's a full approach, right? It's based on the exactly cause and effect relationship. If you can detect, because I spent this much, hence I did gain this much. So the cause and effect. And then if you cannot have a cause and effect relationship, then you will have to look at, is there an association between the expenses and the revenue recognized in specific time period. If even association is not able to detect, then you have to look at the systematic and rational allocation of specific period. And then fourth one is in a period incurred without regard to the related revenue, right? So then the last one is without the revenue being recognized, you still need to incur that expenses, right? So generating revenue or not. We will also encounter this scenario in a future study. Measurement. So when we talk about the measurement, in accounting, we have a lot of way of measuring things, right? And the current GAAP have employed the mixed attributes of measurement model. We usually talk about a historical measurement, and we'll generally gradually introduce a net realizable value. And then also we want to talk about what is current cost, what is the present value, what is the fair value, okay? Historical cost means the original transaction value adjusted for depreciation and amortization. For example, you bought asset at $100 and you amortize the $20 for this year and another $20 for next year. On the third year, your cost of this asset is only have a $60, right? So this is called a historical cost plus depreciation and amortization. Net realizable value, I remember in financial accounting, we also introduce a little bit as well. Basically, the amount of cash into which an asset is expected to be converted into ordinary course of business. I remember we said if we cannot record or not able to use the historical cost, we wanted to find how much the money that we can in exchange, right, into for the asset to be sold. So therefore, we call it net realizable value. Like let's say antiques, you probably never know how much it was cost and how much depreciation it was, but right now you wanted to auction it. So therefore, the net realizable value is the amount of cash into which the asset is expected to be converted in the ordinary course of business. Current cost. Current cost is that the cost that you would have to incur or purchase to reproduce that asset, right? So for example, same chair, antique chair, a chair can worth $20,000, right? For certain characteristics. But if you say using current cost to evaluate a chair, that will only be like $80 because if I reproduce exactly same function chair, it's only cost me $80 to reproduce that asset, right? Okay, then we totally talk about the concept of present value. So although we might able to evaluate these three different cost base, we also can use the present value to evaluate transactions. The current value of future cash flow calculated by applying time value of the money can also find out what's the cost of the chair. For example, if the chair used in this company for 10 years, and each year this chair help me to produce and has a cash flow stream for $5 each year, right? Its a sacrification can produce $5 of cash inflow for next 10 years. Then I will use the present value of this $5 for 10 years and multiply the present value multiplier, and to find out what is the present value of this chair. And we usually do this at the bond pricing, right? So we know the bonds we're generating future interest income and principal amounts, right, from day 1 to year 10, and then we want to pricing this bond. So we use the present value method. Fair value. Fair value means that the price would be received to sell the asset or paid to transfer the liability in an orderly transaction between the market participant and the measurement date. This means that if I want to sell right now, how much people would pay for this, okay? Okay. So historical cost, let's say, historical cost is in other words original transaction value. It's a basis measurement on the amount given or received. For asset, it's the value what is given in exchange, usually cash, for the asset at the initial acquisition. For liability, is current cash equivalent received in exchanging of assuming the liability. And then usually long-lived revenue providing assets, equipment, and adjusted subsequent to its initial measurement by recognizing depreciation or amortization. Net realizable value. Like for example, net realizable value, some assets are measured at the net realizable value, which is defined by FASB as the estimating selling price in ordinary course of business, and less reasonable predicted cost of completion, disposal, and transportation, right? Intuitively, net realizable value is net amount of cash into which the asset or liability expected to be converted in ordinary course of business. For example, if an inventory could be sold for $10,000 and the company would incur additional cost of $2,000 to complete its transportation to the customer, the inventory's net realizable value is going to be $8,000. Okay? And the current cost means the company sometimes report a current cost, particularly if they operate an inflationary economy, and the current cost of an asset is the cost that would incur to reproduce the assets. The present value, because it's important to many accounting measurement, present value is the focus of FASB concept SFAC7, which provides a framework of using future cash flow as a basis for accounting treatment measurement. And it indicates that the objective in valuing of an asset or liability using the present value is to approximate its fair value. The last one, fair value, originally called the current market value, is a basis measurement on the price that would be received to sell the asset or pay to transfer liability in orderly market transaction. Fair value can be measured using market approach, income approach, or cost approach. Market approach is valuation based on market information. Income approach is estimating future amounts and then mathematically converts those amounts to single present value. Okay, and the cost approach is the estimate amount that would be required to buy or construct an asset of similar quality and condition. Okay, so which of the following is not a measurement attribute to define the fact of conceptual framework? Okay, so net realizable value, yes. Historical cost, yes. Fair value, yes. List price is not, right? Okay, so fair value is very hard chapter, but in chapter 12, you will learn that certain investment in market security are reported at a fair value. Okay, and fair value has a lot of different hierarchy. So the most desirable hierarchy is quoted market price in an active market, right? That you can find the active price for it. The second level of a fair value is the inputs other than quoted prices that are observable for asset and liability. These inputs include quoted price for similar asset or liability in an active or inactive market. So if you wanted to find the price for this asset, but this asset is not on the market, but something similar to these things is actually in the market, then you can price your current asset using a similar asset or liability in the market, and then to find out how much it worth. And the input that are derived principally from the corroborated with observable related market data. Number 3 is least desirable. So what is the least desirable fair value measurement is because the price is unobservable, right? And that reflect entity's own assumption about the assumption market participant would have to price the asset and liability developed based on the best information available in the circumstances. For example, there's the things that you don't know how much is the value because something similar does not exist and itself is never sold in the market before. So this unobservable ability of the market price has to be developed based on the owner's own assumption or some information that is available to the owners to tell the owner how much this worth. Okay, and an example is that in chapter 12 we will learn that certain investments in the marketable security section are reported at the fair value. The fair value in this case would be measured using the quoted market price from NASDAQ or New York Stock Exchange or other exchanges on which security is traded. And in the chapter 10, for the second hierarchy, we discuss how companies sometimes acquire assets with consideration of other than cash. In any non-cash transaction, each element of transaction is recorded at the fair value. If one of the assets in the exchange is a building, for instance, then quoted market price for similar building recently sold could be used as a value of the building. If there were no similar building recently exchanging from which obtained a comparable market price, the valuation could be based on the price per square footage derived from observable market data. And then the least desirable one, which is unobservable input, the example would be asset retirement obligation, okay, which is discussed in chapter 10, are measured at a fair value. Neither level 1 nor level 2 inputs would be possible in the most ARO valuation situation. Fair value would be estimated using level 3 inputs to include present value of expected cash flow, estimated using entity's own data if there is no other information indicating that the market participant would have a different assumption. Okay, so fair value hierarchy concept check. Which one of following is not true? A. Fair value hierarchy reflects the subjectivity of inputs used in the fair value. Fair value hierarchy reflects the subjectivity of inputs used to compute fair value. I think it's true, right? Second, level 1. of a hierarchy refers to quoted market price. This is true. Level 3 of fair value hierarchy refers to inputs that are not directly observable. That's true. So must be based on assumption. Yes. Level 3 inputs are preferred to. No. Level 3 is not preferred, right? Less desirable. So A is right because this talk about level 3. Because when anything is not, when there's nothing is observable, so you have to reflect in your subjectivity of the inputs used to compute the fair value, right? Okay. And then now we just quickly introduce a fair value option. So GAAP gives a company the option in some circumstances to choose whether or not to report a specified financial asset in their fair value. And then this provides company a way to reduce volatility in reported earning without having to comply with complex hedging accounting standards. It also helps to converge with international accounting standards as well. And we're just gonna quickly discuss the disclosures, right? So there's several different way of disclosure. A full disclosure principle requires that any information useful to the financial statement users or decision makers to be provided in the financial statements. Okay, is subject to the cost effectiveness constraint. Such information can be disclosed in a variety of ways. So full disclosure, you got to requires financial reports should include any or all information that could affect decision maker. And this information can be disclosed in the ways that parenthetical comments or modifying comments, places on the face of financial statements, or disclosure notes convey additional insights, and then supplemental schedule and tables report more detailed information than is showing on primary financial statements. So let's say summary of recognition, measurement, and disclosure concept. Recognition, we usually talk about general criteria, right? And then you gotta meet the definition of an element, has measurement attributes, is relevant, is reliable, and is faithfully represented. And measurement, a mixed attribute model in which attributes used to measure an item is chosen to maximize relevance and representation faithfulness. We are choosing 5 ways of measure: historical cost, net realizable value, current cost, present value, and fair value. In the disclosure section, the GAAP says that financial report should include all information that is effective or can affect decision making. And then you can put it on the parenthetical amounts, right? You can put in the notes, and then you can put in the supplemental tables. The last thing we wanted to talk about is the evolving, right, GAAP. GAAP continues to change, right? In particular, US and international GAAP have been evolving over time from emphasis on revenue expenses to emphasizing asset liability. Okay, we know that the balance sheet and the income statements are intertwined and must reconcile with each other. But which comes first, identify revenue and expenses or identify asset liability? So if you are using revenue and the expenses approach, under this approach, these people emphasize the principle of recognizing revenue and expenses, with some asset and liability recognized as necessary to make the balance sheet reconcile with income statement. So if it's an income statement approach, that means you are more focused on whether transaction is generating revenue or expenses. Then along the way, you will find out whether you will recognize certain assets and liability count just to trying to make sure the balance sheet and the income can reconcile with the income statement. In other words, income statement is the boss, and balance sheet is just trying to reconcile with it. However, if you're under the asset liability approach, you recognize and measure the asset and liability that exist at the balance sheet date. It's more focused on the financial position of the company, right? And this is more focused on financial change of the company. And then in this case, that recognize and measure the revenue, expenses, gains, and losses needed to account for the change in this asset and liability from previous measurement date. So basically, in this case, the balance sheet is the most important thing. You are focused on what is the difference between this period and the last period. And then what happens is the income statement is the ones to explain the difference between last period and this period, right? So the boss is the balance sheet. And the involving gap is actually involving from income statement approach towards balance sheet approach, okay? Okay, so the last thing we wanted to emphasize is accounting concepts development as well. So since 2010, the FASB and the IASB work separately on their conceptual framework, and the FASB has worked on the relatively narrow projects such as definition of materiality, more general disclosure framework, and the IASB in contrast has moved forward with a more comprehensive overhaul of conceptual framework. And IASB's 2015 exposure draft of its concept and statement addressed a range of issues such as the objective and qualitative characteristic of financial reporting, the definition of key financial statements elements, when to recognize and de-recognize assets and the liability, when to use various measurement approach, and the distinguish between net income and other comprehensive income, and what constituting a reporting entity. Okay, so I basically briefly went through the slides of the chapter 1. I hope some of my notes can help you to understand the concept better. But as a summary, in this chapter, I do not require you to remember any meaty like this. All I want you to do is to walk away with what is the framework, right? Financial framework, reporting framework, and what is the measurement base, right? And what is the difference between IFRS, ASB versus FASB, right? And what they do, okay? And also, what is a cash accounting versus accrual accounting? And what is the major set of financial statement that you have? And what is the elements of the financial statements? So, in other words, this is a very big overview of the financial accounting, right? And most importantly, why financial accounting matters. Okay, so I will give you guys a certain exercise presentation during our face-to-face time, and I encourage you to read on your own and do the Learn Smart by January 27th, right? And I think this chapter is important, but more importantly is to get you warmed up, okay? And I will see you guys in the class. Thank you very much.